Good morning, traders. It's 8:01 a.m. Chicago time on the 21st of January 2016. It's a Thursday. Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not indicative of future results. A lot of news flow overnight after yesterday's very large swing. The U.S. interest rate futures imply 1% chance of FOMC rate hikes in 2016 for 4 FOMC rate hikes in 2016, according to the Financial Times. Verizon reported this morning 89 versus 88 cents, 34.3 billion in revenue versus 34.1, beating. The ECB came out a half hour ago. Actually, they announced at 6:45 Central, about an hour and 15 minutes ago, that they're leaving their main refi rate unchanged at 0.05%. Initial claims came out a half hour ago. It's 293,000 versus 278,000, higher than expected. Continuing claims 2.21 versus 2.25, lower than expected. Mixed results there. January Philly Fed business outlook came in at negative 3.5 versus negative 5.9, so a lot better. ECB's Draghi still in his press conference that started a half hour ago. ECB's Draghi reiterates that the ECB still has plenty of monetary policy tools as well as the power, willingness, and determination to act. ECB's Draghi also said that they will review and possibly reconsider monetary policy at the next meeting in March to look at full range of policy options. This is part of the prepared remarks. My financial world idol and fellow transcendental meditator Ray Dalio in Davos today came out and said, if you're not aware of who Ray Dalio is, he is the head of Bridgewater Associates. It's the largest hedge fund in the world. He said that the world no longer has a locomotive, that China is no longer the engine behind growth globally. There is no country that is driving world economic growth. Dalio also said he was unsure how effective monetary policy was, and he wondered whether it could spur growth going forward. Pretty dire comments there from one of the world's greatest minds when it comes to global markets. Looking at what we have for today, at 9:30 Central, 10:30 Eastern, we have natural gas. Because Monday was a holiday, we get DOE crude oil inventories. That comes out at 10 Central, 11 Eastern. DOE U.S. gasoline inventories expected at 1.5 million. U.S. distillate inventories expected at plus 750,000. U.S. crude oil inventories expected at plus 2.75 million. Other than that, there really isn't much on deck as far as speakers or any other releases going forward. Let's have a look at what we expected yesterday versus what we got. So yesterday we saw that we were likely to open outside of the prior 2 days range. Some strong selling in the overnight session is covered in yesterday's Trader Bite. The expectation is for it to open outside of the range, test up into the prior day's range, which it just came up short on. It tested to 1852.50. The prior day's range low was 56 and a quarter. And then it did exactly as we expected, rotated down, chop, and then move lower. And the target outlined yesterday was 1810.75, which is this high volume node that's right beneath us. The expectation is that the market is likely to fail through if it cannot hold this 48.75 composite low volume node, this very low volume node that separates the upper distribution from the lower distribution. Then it's likely to if it tests and falls through, then it's very likely to the natural process, as I said, for the natural gyration for the auction is 1810, and it did just that yesterday. I know to many people's surprise, it got down to 1810, small bounce, and then it pushed through to 1804 quarter. It actually put in a very weak low yesterday. This low is not very strong. However, the ensuing buying was very, very strong. We had a very massive rotation from 1804 and a quarter to 1869 and a quarter, giving us 65 points in a rally to make yesterday neutral, even though yesterday had a very wide initial balance, 22 points, and it extended that initial balance down. It essentially doubled the initial balance down. It ended up going neutral on the day. The market, the way it was trading, it seemed like it would finish on a neutral extreme, which means that we take out neutral again, just as a reminder, is when the market takes out the first hour's high and the first hour's low. The first hour is called the initial balance. The explanation behind that is the higher time frame business is likely to get done within the first hour, and we mark those extremes in that first hour, and we use that as a rule of thumb or as a measuring stick for the rest of the day. When we break both sides, we have what's called a neutral day. When we have a neutral day like yesterday where it pushes one side, so we have normal variation type day, meaning we push one side, which is what is most common, but not the other. We push one side to the extent that we did, and then we push the other side on a 65-point rotation. That is a very serious indication that a much, much higher time frame is interacting in the market and was seeing prices around the 1800 area as very valuable or too cheap. And so there's an excess low that's normally expected down there, and we end up having this as our base day. This becomes our base formation day, and then the next days are likely to be up, up, and up as the market seeks its sellers, starts to move up to seek its sellers on the other side. And yesterday, because it did not close on a neutral extreme, meaning it goes neutral and then it closes within the top 25% or within the near the high, that if yesterday had been neutral extreme, which it's not, this would be very dire for shorts. I would be cautioning shorts a lot to look into hedging their position and so forth. What it did have is it dropped 20 points from the high, so it recovered about a third of the way down and closed near the initial balance, making it a neutral normal day. It's still a very important day. We have not had this kind of action for a while, since August. If we look at this on the daily composite chart, let's zoom in here. Let's thicken these bars up. You can see that there's just a massive tail on this day, a clear rejection of lower prices right up against that high volume node. As I mentioned before, this high volume node is very important to note because it takes us from 1848 all the way down to 1744. That's the next key distribution area. If the market stays below that 1848, especially if it revisits this high volume node and starts to move below it, then your next swing low is likely to be in the 1744, 1745 area lower. That's quite a distance away. Very thick, a pretty wide-ranging distribution area here, but we did test this very sharp high volume node yesterday, and we did get the reaction that's expected, and that is buyers come in and defend that area as cheap, and they did. And so that's where we are today. It's a very key day today to see what kind of follow through we have. Note that we drew this composite yesterday. So yesterday, without the current at the beginning of the session, it looked like this. It basically encompassed the 3 days before it: Friday, Tuesday, and well, this Monday should not be here actually. Friday and Tuesday. That Monday did not have much volume, but the VPOC here is 1872 in this area, and we came right up against it yesterday before we stalled off. But the overnight high came right up to it. 1876, 1872 is down here. That is the point of control. I need to remove some of this data here from Monday. It doesn't count, but 1872 is the area that has the highest volume. The overnight session went to 1876, so it's the market has tested that balance zone from below. I expect a fair amount of resistance here today coming into the session. That's basically the conclusion that gives us. As we come into today, we're looking for that to be fairly strong resistance initially. The overnight profile is very boxy. There's no consensus on value. There was a battle throughout the range. The volume overnight 667,000. That is approximately 5 times higher than what we would consider to be normal, based on 1,400 days of overnight volume. So that's outside of the first sigma, or 70% of the data set. So there's a lot of activity that's going on here as we push back up. So what we have is basically a cup and handle type of formation. It may be forming the handle here for a pivot point push through. But again, 1872 is likely to cause us to get tangled up. I expect today to be an inside day. I expect today to be a resting day, a digestion type of day. It would not surprise me if the market was to attempt higher, fail, and then start to move lower to seek those buyers again. The areas to watch out for: 1840, the point of control, and then this key low volume node here in the 1829 range. Those areas become important today if we start to move down, to look for buyers again, to continue this leg down. This is an impulsive move up. I'm looking for a pullback, and then I'm looking for a continuation eventually. Maybe tomorrow, maybe it'll happen today, I'm not sure. But overall, the market has gotten a little bit ahead of itself, and it corrected during yesterday's close. I expect it to attempt higher, and then I'm looking for a responsive market yesterday. As I said yesterday, Hypo 1 was worked out perfectly. With the extended target at 1810, I was actually kind of surprised that it made it there, but there was quite a bit of range. But today, I expect I expect both sides to kind of dig their heels and see what's next. And in doing so, I expect it to become responsive and come back towards the point of control from yesterday. That's my primary hypo. And looking at the overall picture, 52-week lows yesterday shot way up on that sell-off. Very high, a very high push there on the New York Stock Exchange. 52-week lows making new highs above what we had in August. The put-call ratio has dropped a little bit. It was very high intraday, and it came off as the market rallied. Overall, the key sectors, these 5 sectors represent approximately 75% of the S&P. The key sectors did not have as big a pop. Yes, they were down, and then they end up leveling off by the end of the session. But we're still in this bigger downtrend across all of these key sectors. The sectors being Um, Healthcare, XLV is healthcare, XLY is consumer discretionary, XLF is financial, um, XLK is tech, and XLI is industrials. And that's the order they're shown in here. So that's how things are shaping up. I'm not going to go over crude. Crude just cannot get its traction. It keeps making a recovery and then immediately slipping. The market is trading with crude. You can see this V bottom that it put in yesterday, just like we saw in our markets. The Nasdaq got way ahead of the S&P yesterday. The Nasdaq actually pushed fully into the prior day's range and took out the point of control and everything. So techs recovered a lot better than the S&P 500 yesterday, and definitely a lot better than oil. So overall, things are looking not so hot. This does still look like a correction rather than a failure. I do expect in the swing range, in the longer term range, I do expect it to find a bottom and then start pushing back up to retest the key point of control above, which was the 1915 area at least. Once it gets to 1915, then it's time to reassess and see if the market is ready to move back into the larger range, which we've occupied for most of the fourth quarter of last year. And that takes us back up to 2073. So we have to take these one step at a time. But overall, yesterday, the action was very bullish. However, we did leave, the caveats of yesterday is that we did leave a weak low behind. We did have a good thrust, good push up, up and back into the prior day's range, but it did let go pretty quickly once it got up there. To me, it just seemed like buyers, a higher time frame buyer stepped in, squeezed a lot of the shorts out, and the book may be balanced, and that's part of what supports the primary hypothesis being a responsive type of trade. We'll see what happens today. Again, I advise you to just sit out the first 15, 20 minutes, half hour, let the market set. Don't try to catch the market as it uh, as it's setting up. We had a lot of alarms yesterday. I know a lot of people held on to trades well beyond their risk levels. It's a natural thing that us human beings do, but it's just, sorry, but it's just stupid to do that. It just does not make sense to stake 20, 30, 50% of your trading account trying to find a bottom. Oh, this has gone too far. Let me buy it here. I can't get short. Let me buy it. Let me buy it. Let me buy it. Just let it do this. Let it, yes, you missed a 65-point rally, but the loss that you took is worth more than 65 points per contract trying to find that rally. So even if you caught this perfectly, chances are you were probably flat on the day. How about we don't go down so much and take such a big loss that we're hoping for this kind of rally so we can get flat? How about trading with the trend, trading with the overall context? And the context was very clear. It tried to get back into the prior day's range, was unable. Sell, 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 sell. Look for areas, rotations to sell. I want to remind you again, AMA this afternoon, 1 p.m. Eastern, 12 Central. The invitation is on my Twitter feed, on my website, all over the place. I already have about 30 questions, 30 or 40 questions. Should be interesting. I invite you to join. It should take about an hour, hour and a half. You're free to ask whatever questions you want. I'll catch you at noon Central.